Hello and welcome to a presentation I'm calling The Real Easy Way to Easy Street, Investing as It Should Be, Easy. The really quick version. This was originally a 5-part series, and I highly suggest you check those out if you like this little abstract. But for those with short attention spans, I'm going to hit the highlights here in this video. Here's the stuff I talk about in depth in the full video. Let's assume what I said made you trust me enough to listen to the rest of my spiel. And we'll also assume that you already know that inflation will eat away at your savings over time if you don't invest, and you also know that even though the stock market can be volatile, meaning it can go way down just as much as it goes up in the short term, it's still the best way known to man to grow your retirement savings over the long term. Assuming those things, we can jump right into the first question you need to answer, which is not what stock should I buy, it's what asset allocation should I shoot for. Section 1 is about the all-important asset allocation, or put another way, how should I divvy up my investments to maximize profits and minimize risk? This is a question that you need to answer for yourself, but the basic rule of thumb is that if you're young, you should have more of your investments in stocks, while if you're closer to retirement age, you should start to transition more into bonds or cash. There's lots of free tools on the internet to help. Just search asset allocation or talk to a financial advisor. Asset allocation provides instant diversification. These are the common asset allocation buckets. In my full video, I explain more about each one, but here I'll either assume you already know this, or you can do more searching on the web to find out more, or you can watch my other videos. So we have large cap domestic, mid cap domestic, small cap domestic, international and emerging markets, cash and bonds, and finally, play money. Play money is the smallest portion of your portfolio, and with this money you can play stock picker if you like to watch that Kramer guy on TV, or if you want to try your hand at trading stocks or trying to time the market, which I talk about later. After you choose an asset allocation, then you can ask what to invest in. Because diversification is a must, and trying to follow 30 or 40 different stocks is time-consuming, I suggest you invest in mutual funds. But be very wary of high expense ratios and fees, and never buy a loaded fund. You can get load, fee, and expense data about any fund pretty easily on the internet. Now, better than mutual funds are index funds. This is because something like 80% of mutual funds fail to beat the index they're measured against. So why not buy the index itself? Index funds are great because they're not actively managed, and so they have low expense ratios, aka they're cheap to own. But even better than index funds are index ETFs. These are what I recommend most, especially the ones you can invest in for free. That's right, you're not charged a commission to buy them. You get instant diversification, they're cheap to own and easy to buy, the building blocks of any portfolio. And of course I go into these in more detail in my video series. So, my official recommendations are, and since I'm just expressing my opinion and not forcing you to do anything you can't sue me for any reason, IVV, which is a zero commission ETF that mirrors the performance of the S&P 500, use that as your large cap domestic allocation, IJH for mid cap domestic, IJR for small cap, EFA for international, and EEM for emerging markets. These are all zero commission ETFs, very low expense ratios, no loads or fees, easy to buy and own. For cash, I recommend any old money market fund, they're all pretty much the same, or just keep your cash in the bank. For bonds, I use MUB, which is a municipal bond fund, and HYG for corporate bonds. Now that we have some good ideas on what to own in our investment portfolio, we can get into the one thing that seems to really screw people up when it comes to investing, and that's how and especially when to invest. In my video series, I talk about how people look at a chart like this one and think, oh man, if I could buy at those lows and sell at those highs over and over, I'd be so rich I'd be able to retire in no time. Then I virtually reach through the computer screen and slap you back into reality. The reality is that timing the market is really hard because of two emotions, fear and greed. So for the sake of time, let's assume you understand that if you want to try trading instead of investing, then you should do it only with your play money. Leave your other asset allocation buckets alone. So instead of timing, you want to use the powerful and easy technique of dollar cost averaging. You simply add to your core portfolio positions in equal amounts in regular intervals, say $100 a month. You buy $100 worth of shares, no matter if the market's gone way up or if it's cratered. When the market is way up, your $100 isn't going to buy you as much. When the market is down big, your $100 buys you more. So you end up buying more shares when the market is low or the price is low, and you buy less when it's high. The other powerful and easy to use tool is the miracle of compounding. This simply means that whatever dividends or capital gains your investment pays are reinvested back into the investment. Both of these tools allow you to continue to accumulate shares and grow your portfolio over time. And that is the goal of investing, growing and accumulating wealth over time. And these tools are so easy, you set them up automatically and then forget about them. No need for expensive advisors, no need to spend hours and hours researching stocks and economic trends. It really is easy. The web tools section was about some websites I like and how to look up interesting things like stock charts and expense ratios. I'll assume you already know all about that stuff. With the wealth of information that's on the web, our generation of investors has a distinct advantage over the folks that came before us. So do some searching around and check it out. And lastly, a list of tips and tricks that I've learned over the years that I think are very important. In my full video series, I talk about each one in more detail, but here I'll just hit the bullet points. Again, if you're going to buy a mutual fund, buy a no-load fund and compare expense ratios. Keep a close eye on your allocations. Rebalance every 1 or 2 years. Does your employer offer a 401k? If so, enroll now and max out your contributions. At least get the full match. That's like free money. If you watch CNBC or read the Wall Street Journal, you'll find that half the articles contradict the other half. One expert is yelling buy while the other expert is screaming sell. Nobody knows where the market is going to go in the future. Always maintain an emergency cash supply. Keep about 3 to 6 months of expenses as liquid as possible. If you don't know how much money you would need, create a budget and find out. Dividends and capital gains get taxed heavily. Index funds are great for taxable accounts, but if you're going to own dividend-paying stocks or mutual funds, own them in a tax-advantaged account, such as an IRA. Look around on the web for more information or ask a professional. No, it's not too late to start investing. Doesn't matter if you're 18 years old or 80 years old. Keep track of your portfolio's performance. Compare your entire portfolio to an index, such as the S&P 500. You want to know where you're at. The U.S. economy is based on consumption and spending. We all know that. But you have to save too. Dollar cost averaging is a great way to help you save for retirement. Resist the urge to chase whatever's moving the fastest. Stay calm and stay diversified. Part of the whole point of your asset allocation is that some things are going to go up and some are faster than others. You don't want to try to keep chasing the one that's moving the fastest. You'll end up hurting yourself. If you're interested in a financial advisor, go with an independent one. Always check what they're recommending to see if they're loaded funds or if they have high fees. I do suggest that you watch the news, pay attention to world events, especially what the Fed is doing. And know the difference between trading and investing. If you read other articles or watch other videos on YouTube, ask yourself if they're talking about trading or investing. Here's a hint. If they're talking about moving in and out of the market and studying charts and doing all this analysis, they're probably talking about trading. If you do want to get interested in trading, here's a few tips there. Obviously, well, tips are for waiters. Don't buy stocks because you found a fax in the machine or a friend of a friend said that something was going to go up. Pay no attention to the garbage written on internet message boards. Never buy a penny stock. They are scams. Don't do it. If you're going to trade, learn how to place orders, limit orders, stop losses, etc. Do not make the mistake of thinking that a stop loss is automatically going to protect you from any losses. Stop losses do not protect you from gap downs. Do not trade on margin unless you really know what you're doing. Get yourself in huge trouble if you trade on margin. Be very careful trading stocks during earnings season. A couple of adages on Wall Street are tried and true. One of them is buy on the rumor, sell on the news. And there's no such thing as a free lunch. Those articles you see that talk about black boxes that spit out recommendations of when to get in, when to get out, yada, 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 forget about them. Scams. And that's basically it. Again, I highly suggest that you watch my full video series for some more information. I hope you enjoyed this. You see my email address right there, easystreetguy@gmail.com. I'd love to get some feedback. Let me know if you thought this was helpful or if it was full of crap. And good luck out there.